Well, good afternoon, good evening, good morning. The outlook here for commodity markets in general, I think, are is extremely bullish. We have high prices in a lot of grain and food prices, iron ore, copper pricing, zinc pricing, nickel pricing. We have become so comfortable in the world with deflationary conditions and cheap commodity prices that when we get a rally, as we have currently, we tend to think that prices are overvalued. And I've been analyzing markets for 36 years. My company, the Hightower Report, is a little bit unique in that we analyze all commodity, actively traded commodity markets and their interactions with other non-traded commodity markets. And I think that's very important, not only from the industrialization aspect. The interaction of the markets have grown tremendously, and arbitrage, volatility, geographical production differences, differences in geographical demand, all those kind of dictate that you take a broad analysis to watch what other markets signal so that you can predict what's happening. And the Hightower Report every day produces about 25 pages on all the actively traded commodities, and that keeps us attuned to how these markets interact. A primary interaction that should be noted is looking at palm oil and vegetable oil and soybean oil, and in fact, a lot of commodities with the price of crude oil. In fact, some of the edible oil markets have such a tight correlation with the energy markets that it's difficult to distinguish the chart. So I just want to make a point starting out that internal fundamentals in the palm market are very important. But we have to be aware of what's going on in the big picture, because I think they're going to see an amplification of price gains because of external events. This is a money supply chart. It's no secret. I think we're well above 10 to 12 trillion dollars globally in terms of just stimulus packages to get through the coronavirus. And the U.S. money supply growth has exploded. And as we're going forward here, we're going to see even more explosion. The Bank of England, Bank of Canada, the Bank of Japan, the U.S. Fed meets in a couple days. More stimulus may even be handed to the market today as we're recording this. And so all those money supply and stimulus packages are going to get larger. And what happens is we've had China is largely sidestepped. And again, that's not to play down how much damage was done to their economy, but it's just to suggest that this can be gotten around. And with all the stimulus that's out there and the pent up consumerism, we may come out of this with a reflationary, if not inflationary, psychology. And something that I think makes it even more probable for inflation is the fact that in my 36 years in the markets, I have very rarely seen such a conclusive idea that inflation is not necessarily impossible, but extremely unlikely. Why? Because we haven't seen it in so long, and we were so comfortable with global central banks coming in and stopping inflation before it got a foothold. And now we're in the opposite scenario with the U.S. Federal Reserve, in fact, inviting inflation, and other countries' central banks inviting inflation. So that's another major issue why I think you have to be careful that commodity prices go further than what you would perceive internal fundamentals to justify. In the outlook here for the dollar, this is a very significant event. I think you see from the 1984 timeframe to the present, there's a downtrend in the world value of the U.S. dollar, and I think that's going to continue. Why? It's because we've seen a dramatic expansion of items that you could use instead of the dollar to protect yourself in times of uncertainty. We've now seen a globalization with the Eurozone, with China emerging on the world scene as a very important force. And so to be truly diversified, you now have to, in times of uncertainty, you have to move beyond the dollar and make sure that you're distributed around the globe. Secondly, in the coming 6 months, with the change in leadership in the U.S., from a U.S. citizen perspective, we had a push to be more America first. And now we're going to track toward the global citizenryship, whether it comes with trade agreements, whether it comes with the U.S. Complying more with pollution rules. And so that also takes the U.S., I believe it's going to force higher cost on U.S. Companies than we've seen in the past. So the dollar is going to continue to decline. And historically, that has been a situation that really does manage to drive inflation. And so you can see where we could move just to a normal historical price level. So the dollar still has maybe as much as 20% to go on the downside. Another element is that Goldman Sachs and Citigroup and a number of large trading entities are now starting to suggest we're in the midst of the very early beginning of a commodity bull market. And again, this chart shows we had some deflated prices because we snuffed out and started snuffed inflation and started to slow in the economy. And then back in 2008, we had fear of depression. We obviously had fear of depression earlier this year with the global lockdowns. And so we got ourselves to a point in history to where the external and items from a commodity market are very, very incendiary in our opinion. You also have a situation stacking up in which, as I said, the U.S. Federal Reserve will not raise interest rates, even though they see the beginning of price pressures. And so with interest rates and the global benchmark of interest rates expected to remain very low, we really do have a very potential ignition for physical commodity prices. So if you look at Malaysian palm oil, we certainly have had a positive reaction in prices to the reduction in output, the weather focused in the marketplace, La Nina. We've had wet palm weather, palm oil problems. We've had dry South American problems, but we also have China in the background, continuing in a fairly strong demand function. But there's something bigger at work here when it comes to the edible oil markets. And that is that as we globalize and as we come back in the recovery of the globe, we have this change of diet that's still taking place in the background in developed countries. And as a result of that, the consumption of these processed foods and the use of oil and edible oils in that is going to continue to be extremely important. And something that I think needs to be noted is if you look at how large palm oil production is of the total edible oil complex, on any given year, you can have 5 or 6 or even 7 times the amount of production in palm oil as you have in all the other edible oil markets combined. And so what that means is that not only is it very important what the actual production of palm is, but it also means what's going on inside Malaysia and Indonesia when a couple years ago, the implementation of a push toward biodiesel. And now this year, the implementation of some taxing. And so those have exponential impacts on global prices. And as we get to higher prices, the differentials that you're going to see between some of these markets, say for the bean oil market, continuing to rally aggressively off what's going on in South America, the smaller, tighter markets can outdistance these other comparative products. And so they pull each other up in sync. You know, if the arbitrage continues to rise and rotate back and forth. And, you know, a good example of this is in the palladium and platinum markets, where palladium went to $2,500 an ounce. And I think it's currently $1,400 more expensive than platinum. And so now we're finally starting to see that rotation. And so that's what you get, a cycle of higher prices. And so I think it's very important to realize that even if you have a minor setback in one of these other edible oil contracts that's very small relative to palm oil, what ends up happening is those buyers have to do non-characteristic substitutions. And so it provides surprise demand across the sector. So it's very important. And so you look at casually weak vegetable oils the last 10 years. So if you look at the last 5 years, it would appear as if these prices are expensive. Obviously, the palm oil market has a price advantage at this time. If you currency adjust to that, it might be a little bit different. But I want you to go back to 2010 and 2011 and realize that at that point, where those prices are at is more indicative of where prices should be going, in our opinion. So again, maybe you get short-term overbought, and maybe we rallied because of this setback in production, a peaking out, so to speak, of palm oil production. But again, as I go through longer-term fundamentals, I find out the world vegetable oil market, look at what's happened with ending stocks. And look what's happening with ending stocks projected for 2020. So macroeconomically, with a cyclical type impact from consumerism and restaurant oil consumption and things of that type, we still are expected to see lower ending stocks. So instead of rebuilding supply and getting an excess, which is what you should have a excess in supply after a environment in which demand falls off. But what happened is production fell off. We had a drought in 2019 in the palm production. We now have some problems in South America. And going forward, we see a little bit more biodiesel coming into the equation, but that may be slowed until we get prices up to a higher level, until we get oil prices up to a higher level. And at this juncture, I don't believe that biofuel, biodiesel is the reason why edible oil prices are correlated to energies. I think it's a big picture type of thing and not necessarily biofuel. And when that does happen, if Malaysia and Indonesia begin because of higher production in the coming year, or because of very high oil prices, when they begin to try and push to that B40, which seems unlikely to push toward that in Malaysia right now, that has an inordinate amount of impact on how much will be exported. And so again, that ripples through these other vegetable oil markets. But what's the most important thing to look at this chart, besides the falling production, is where the stocks to usage ratio is, okay? We can look at currency adjusted prices and say, where will the trade migrate to for the cheapest product? But in my view, what has become important in the world market is not whether or not who and where they're buying it from, but just what are we buying? It's not important as much where China's buying their soybeans and palm oil and oil. It's just the fact that they are buying and how much are they buying? Because what we're looking for is a very fluid market that meets demand. And so if we continue to take total supply off the market, and we're down to a stocks to usage ratio, as you can see, that's the lowest in modern times. And you go back prior to 2000, those stocks to usage ratios are basically irrelevant because they weren't in the new market structure. But also, we're in a period of extreme volatility that's going to continue to expand in the world market. Why? Well, as you can see, back in 2014, we had a huge amount, 7 million tons of ending stocks, okay? Our production is massive now compared to back in 97 and 95, okay? And when you have a small setback in a large amount of production, that's a large amount of tonnage that's missing. And so, as I'll show you in a few charts, the demand for these key consumers in the world in general continues to go higher and higher and higher. So when we have a slight change in supply, that means it's a very, very tight, explosive market. On the other hand, when we have a surplus, the amount of surplus is so large that prices can overreact on the downside. So I think you're going to continue to see that. And one last item on here is that the stocks to usage ratio, I think, is more important than the absolute amount of tonnage available. Why? Because it's how long does it take us to use it, okay? Some of these charts are like days supply, and palm oil is in the exact same scenario with the stocks to usage ratio. And a lot of analysts will measure this from a days of supply type of scenario. So we're tight. We've certainly seen a setback in production again, but look at the mismatch. Some of these needs are going to come from a record soybean crush, but their production versus their usage means that their importing is going to continue to be very strong. And you go to the next chart, same thing. Their production versus their usage levels. This is a long-term relationship that will probably never change. And if you look at the Indian government, we have begun to see some major economic improvements inside the country that could finally put them on a path of certainly not the path that China took, but in a better track than has been seen in India for quite some time. So you look at the differential between the production and consumption. So you're talking 16 million metric tons in India, and you're talking not quite as much in China, and so that's rather significant when combined together. Here's the long-term per capita consumption, and this is what I'm talking about. If you look at how much further that India and China could go with their per capita consumption, and this says vegetable oil, but it is just edible oil in general. And while they may, those two countries may not reach the level of the U.S., they have so much further to go. And I think that represents ongoing increased prosperity and wealth in those countries over time. So not necessarily the short-term recession, depression, growth forces, but as you can see, the overall consumption could double and triple versus the U.S. production. So these other oils just do not have a chance of making that up. And so it's going to continue to come from palm production. And then here's what we see, not just from a single year that production's coming down. You know, we've kind of leveled out at from 2013, did have a high in 2018. But the slightest setback in production now is going to have a very significant outsized impact on pricing. And if we had not had a series of issues since 2013, and had we not had a trade war, and again, I'm not too sure that the trade war did much other than upset psychology, because again, I don't believe that China's going to buy to appease the U.S. I think China's going to buy what they need, and they're going to buy it where they need to buy it, and largely. And they may time those purchases to a certain degree, but in the end, what would have happened to prices, you know, if we had not had a little bit of a setback in demand during this time frame? So if you look at Malaysian palm, the inventory, again, now we're back within vicinity of the 2016, 2017 lows. So while prices appear to be lofty, that doesn't appear to be the case from a big picture. And so if we narrow it down and come into the short term, so we have that declining production. And what happens in a commodity market is that major lows in prices take place at the period of highest supply. So when you're in a cycle and you have higher production, that's when prices can pause or go down. And that may seem simple, logic, but difficult to determine when are we at the highest production level or highest supply. You have to do that in retrospect and realize that you're in the midst of a new trend. So we have this recovery in energy prices. We have stocks that are tightening. So we have the world palm production will reach a record in the coming year, but stocks will still fall. So what does that tell you when you're producing very strong amounts, but yet what you end up with is lower? And so we could hit a 33-year low in prices. So you have to be careful assuming that we're expensive and prices have run too far too fast. So Indonesian production is a record high for the 5th year in a row. So that offsets some of the Malaysian output. But again, it's not exactly where the high production is, what's the total production in the world. Certainly the record soybean oil production could help the market, put in a significant peak in early 2021. Also, maybe China won't buy as much as they have last year, but they still have huge feed requirements. We're still kind of rebuilding the hog herd. They are still building more crush capacity, and they are boosting their capacity to import soybeans. And I think out of the recent 5-year plan, there was a lot of indications that they were deciding again to build inventories, to build strategic supplies, to build out the internal portion of the country, to begin a tech center in the south. So there's a lot of stimulus that's being applied inside China. And so as China goes, so goes the world economy. And a lot of gas and stimulus on the rest of the world could mean that the non-Chinese vegetable oil demand will begin to pick up. So that does mean, though, that China's crush is they're going to throw more soybean oil out, and that will replace a little bit of vegetable oil needs. But India's veg oil imports estimated to be down. And again, you look at car sales and look at other energy consumption. Now we're starting to see that come up. This may sound a little bit strange, but when you look to gold imports and gold retail purchases inside India, it gives you a sign, maybe a leading indicator sign of what might happen with other commodity imports and consumption. So just a note to watch. And that hasn't necessarily picked up yet, but we'll see if that is something that takes place in the coming months. I might also add that India has been very price sensitive, whether it was from gold or edible oil, or whether it was from long-term items, crude oil, natural gas. They have become very competitive for pricing, meaning that they demand cheaper pricing. And why is that? Well, that's also another sign that their economy is still not firming up. And so another issue, 2021 biodiesel consumption took a big hit this first half of this year. But if you note, energy prices have been massively strong and have been rallying despite OPEC adding supply, despite U.S. demand continuing to be anemic. Now we're anemic all the way into the finish the second half. But yet now the end of the pandemic is showing up, and we've had a significant amount of oil rigs and production in the U.S. reduced. I might add that the amount of oil production lost in the U.S. from the peak was about 1.8 million barrels per day. And when you add to that the amount that OPEC plus held off the market, we've come through the energy markets through this potential depression with relatively tight world supply. So like copper and some of these other cyclical markets, we came through a period where we should have built up multi-year surpluses, and we did not. And so that's why I think Goldman Sachs and Citigroup, they're predicting commodity bull markets. La Nina could bring some favorable growing weather to Southeast Asia, but we got to be very watchful of too much rain. I'm not sure if the virus flare-ups are going to be an issue, given the outside general outside work, and that we have seen that in some other areas, but we appear to be past that juncture. So very short term here. So we're going to have a strong correlation in dollars per ton between palm olein and the Malaysian palm markets. But again, I think that that is more likely to take place when you have this fear of slowing or fear of overproduction. And so that should begin to see more arbitrage opportunities as we become more recovery orientated and demand continues to rise. And plus, we will begin trading off of the weather a little bit more, as I indicated. So the spread year to date, as you can see, the Malaysian crude has seen significant downtrending action here. We appear to have reached a level that may have some value. The spread trade in the last 3 years also down to a level that may represent some value. I think it is important to realize that a lot of large commercial entities, they do take a look at these kind of relationships on the charts and on long-term basis. Even the funds, which are not that many fund traders, are trading beyond the crude oil and gold markets, but they are beginning to move out to diversify. And, you know, the money that's involved in mutual funds and financial instruments is very large compared to physical commodity markets. And so a little bit of money from the equity markets into any market like palm or palm olein could be a dramatic influence. And again, they're looking for which market would protect them against inflation. Which market would have the most significant reaction. And so if you get a weather issue in the palm production area, too much rain, that could be an element not only causes forward coverage buying by commercials, but it could bring in some of that money that is looking to protect record high equity market yields. So we seem to be in a solid uptrend here. Again, I don't believe that we're going to see an end of these prices. There probably will be some weather threats. I mean, depending on how much rain that we get, but we have seen an 8-year high, but stocks are at a 3-year low. And we have this big picture cycle that I think is coming into play with a lower dollar, very low interest rates. And so we have seen this very significant volatility over the last several years. And I like to say this: if you look at a market that has been oversupplied and has had slack demand, and yet you see volatility in those markets, that's a very big sign that the directional moves can be large. You get into those sideways consolidations like we saw in 2014 and 2015 in these markets, and you can see the oversupply area. Now we're seeing in a depression slash recession, global recession like we've never seen. Look at the amount of gyration in these prices. So I think that shows you, instead of going very quiet, it shows you there's a very significant heartbeat. And if you go through next slides, you look at some of the palm olein in terms of the Chinese currency. Also, again, expensive relative to 3 years. Palm futures, again, very significant uptrend pattern in terms of their currency. The fact that the U.S. currency is going down, I think, means that almost all other currencies are going to go down. So it may reduce the amount of purchasing capacity by the U.S., but at the same time, we're seeing strength in currencies like the Swiss and the euro and the pound, like we have not seen for many years. And what that tells me is it's a broad-based, diversified trend that's taking place. So I do expect these currencies to continue to gain, and that may lift these prices up relative to U.S. competition. But again, the soybean oil market, the canola markets, the cottonseed oil markets are all very small markets. And we are going to see more biodiesel consumption, which is going to raise the bar on not having problems in the palm production area. And if we get a supply problem of even a small magnitude in this season, we're going to see a very big response and reaction. And that's not always the case. And so I'm very upbeat. You have to be somewhat wary when you have 8-year high prices, but the internal and external forces are certainly very persuasive when it comes to pricing going in the near term. So with that, I'll conclude. And if you have any questions that you would like to add and question before, I'd be more than happy to add that.